Alright guys, it's getting interesting. So here I am zoomed out on the old S&P here, and just want to show you, alright, this is how much we've fallen. You can see how nasty this can really get, right? This April of this year. We gave back an entire year of gains in like 3 months. Okay? So it's normal for markets to do this, come back and retest levels, as you guys have seen multiple times. Looking at this, where do you think we're probably going to go? Pretty obvious right here, right? That would be a correction. And if we did see that happen, about 13%. Pretty normal. So, and the fact that we're not seeing buyers step in yet, I'll tell you that's pretty realistic. So, I want you to also see that sometimes this will happen. So if you started investing in December of 2018 and you bought, right? And then boom, COVID happened, right? Market tanked, went lower than the lows of 2 years before, and it did it in like a couple of days. Now this is very rare to see. That's a true crash. Okay, I mean we came down 35% in like 2 months. That's because people thought the world was ending. All right, so don't expect that to happen all the time. This correction right here is more what you normally see. This is called distribution. So higher, lower lows, lower highs, lower low, lower high, lower low, and then all of a sudden we broke and we got a higher high than the previous, right? Then we came back down to retest and then continued to trend for years. And this is October of 2022, and the market has done nothing but go up until the April tariff tantrum, correction, right? And look where we came down to. Previous resistance. Look at that, right? So now you would want this to happen now rather than way up here, right? Because if it happens way up here, it's going to be a sharper, faster decline. You want this to happen, I repeat, because you get stocks at a discount and your compounding is healthy and the market is healthy and there's less to worry about, right? From a technical standpoint, this is a better scenario. Now, I'm going to tell you, we lost the 50. All right, we're coming down here. We're coming down here. I have no doubt in my mind we're going to get real close to right here. All right. I don't know exactly where. We could go a little lower, or there is a potential that we get some crazy bad news and come a lot lower, but unlikely, right? Considering that the only reason the market's selling off right now is just things are too expensive. That and the Fed is being hawkish, right? But the unemployment numbers actually came out better than expected, so the economy's not as bad as people thought. Okay, so that is negative for the stock market, though. All right, because Fed is less likely to cut rates, which is why crypto is getting absolutely annihilated, right? So looking at this, where do you think we might go, right? Where do you think? Right around here for a retest, right? Because we did higher high. There's your retest. Another higher high. If the crypto cycle is not over and we're not going into a bear market, then you'd expect this to make a higher low right around here somewhere. It could literally be right here, right? Still technically a valid higher low. Or we come back, retest this level, then bounce. Or we could retest this level, break, and that would be the confirmation of now we're in a bear market, right? So you don't know. You don't know. But I just want you to see, like, look how far we have fallen versus how far we rose, right? So from the bottom, Bitcoin did 650%. Bought down here at 17,000 in 2023, you would have made 600% from the lows. Okay? So, why am I telling all of this to you? For a few reasons. A, you want this to happen if you're younger. If you're older, I can understand why you wouldn't. But if you're younger and you want to invest in growth names with high performance, this is what you live for, dude. This is what you want. Yes, we're taking small losses because you didn't time the top absolutely perfect, but at this point, most of you are probably in cash positions and you've licked your wounds, okay? Now you're sitting and waiting. So all we have to do is wait for the big volume to come, right? And you're like, it can't be that easy. Let me just show you it is that easy, okay? So SPY. Here's when the market crashed in April. Look at the volume that came in compared to all this other volume. That, my friends, is institution spying. And SPY did a 10% move in a single fucking day, right? So it came up, came back down, tested the lower moving averages, got bought right there. So you could have just been buying anywhere in here, right? Because you saw that big volume and just sat and waited. And here you are. We made our new high, right? So now it would make sense that we're going to come down and at least test the 200-day moving average because we went in this low volatility trend forever without retesting the 50. We finally retested it once, retested it again, and we finally breached it, right? So now what do you expect to happen? Well, at about this level that we're at now, I would expect that we're going to come back up and try to test the 50 again, right? And then if we can't get through it, which we most likely won't, you're going to sell down and you're going to sell down hard. So you have an opportunity, almost certainly, on this next bounce to buy protection and ride it down. Okay? Other than that, you're compounding on the way down because as you can see, if we fall from right here where we're at now all the way back to here, right? That's another 6% right there. And from the all-time highs, that is 12%, and down to support is a 13% drop. Okay? So, this is why long-term investing creates generational wealth, because let me just show you something. So I had Grok make a scenario here where you invest with my plan that I gave in the Discord yesterday, okay? And I had it do it two different ways so you could see this. Also, AI is the key, right? Like, dude, it's out there, it's amazing. Use it to your advantage, learn to like tell it what you're trying to do and what your goals are and what you're doing now, and it will help you perfect a strategy because it has access to all this information and it's extremely amazing. Anyways, so the portfolio that I put up yesterday, which is consisting of two high yield covered call strategy ETFs, some growth funds, bond income strategy, a little tiny bit of crypto, and a tiny bit of the chat ETF, which is AI only ETF, because I believe that we are in the beginning of an AI and innovation super cycle. I think we're just getting started. That doesn't mean that crashes aren't going to happen on the way, but I want to be a part of it, and I'm willing to risk $3 every time I, you know, invest. So, all right, let me just show you. So I had this do a worst case scenario, which is where the market is down 50% from where we are today, 10 years from now. Okay, that is extremely unlikely. Extremely unlikely. However, theoretically possible, right? Like maybe you bought the absolute top at the end of the stock market. Like, which if that happens, do you really need to worry about money? Probably not. The whole world's about to go fuck. But anyways, so here you go. Worst case scenario. The absolute worst case scenario. Still, by the age of 40, I would be making $5,000 a month. So 10 years from now, I'd be making $5,000 a month in dividends, and I would have a portfolio value of $620,000 while I only contributed $201,000. So still a 400% return, even if the stock market is down from today 50% 10 years from now. Understand that, okay? This is why this portfolio is so powerful and why compounding is amazing, because even if the stock market is down, as long as you continue to invest and accumulate shares, those distributions and those dividends will take care of you. And the high yield does particularly well in high volatility, which is what we have right now, right? So if I had dumped my whole 60K, yes, my portfolio would be getting whacked, but I'd be yielding probably 20% on those ETFs for dividends this month. So When the market gets volatile, this portfolio actually performs even better in terms of an income vehicle. All right, so that's the worst case scenario. 20 years from now, I'd have $500,000 of my own money invested, and I would have a portfolio value of $4.5 million, making $36,000 a month. Okay? That is the worst case. And if you think it's going to get this bad, you're fucking crazy. You're betting against America forever if that's the case. And again, if that is the case, you're not going to care about money. But I just wanted to demonstrate what that looks like, okay? And here's the same thing, right? Um, let's see. So $10,000 lump. They're both the same thing. $10,000 lump today, which I did. $2,000 a month for 29 months or 27 months. Depends when you get the whole 63K in. So obviously these numbers would be a little different, but it's close enough. Okay. Uh, and then a 15K dip buy in year 2. So it's assuming that at some point I'm going to deploy a large chunk of capital, which I can. That's why I'm averaging in, which I will start doing at big key levels, right? Like that 600 level, we get down there, I'm going to drop 15K, like for sure. Okay, but so again, worst case scenario, 10 years from now, I'm making $36,000 a month, or 20 years from now, sorry. 20 years from now, at 50 years old, I'm making $36,000 a month in passive income, which means I could effectively retire at 50. That is in the absolute worst case, okay? Average scenario, so this is typical standard market volatility and movement. By the time I'm 36, I have a portfolio value of 440K, okay? I have invested $137,000 of my own money, and I'm making $4,200 a month. All right. This is again assuming 2K for 27 months, and then $1,200 a month forever with one big dip buy at a certain point. All right. Now, that's 5.5 years from now. Okay. 5.5 years from now, I'll be making that much money monthly, passively, in an average market. Do you understand how crazy that is? I mean, there's people that are watching this video that don't make that in a month, working full time. Okay, this is how powerful this is. You need to make yourself a base like this. All right, now fast forward another 10 years at 40, right? I have $1 million portfolio with just $200,000 contributed. Now, isn't that insane? Okay, and on top of that, I'm getting $9,600 a month in dividends. Okay, you can see these numbers over here are very similar, right? So here's the 36 example, right? 435K. This has 440K. The difference is just like when you buy the dip and how many months you invest the 2,000 at, right? So it's gonna vary. Like there's no way it knows exactly what I'm gonna do. It's just giving me like scenarios, which is what I wanted to show you here. Worst case, average case, best case. Now, let's say that we are going into a industrial boom, like an innovation super cycle, right? And we do 18% total return average, which is high volatility and bull market, which is what I'm basically expecting next year before the top of the market comes. This is what I think will happen is we're going to get high volatility towards the peak. Typically how blow off markets happen, right? And you're saying, okay, well, if you think the market's going to crash next year, why are you not waiting until then to invest? Well, because you miss all that compounding, for starters. And secondly, I don't know the future. That's just my guess, okay? So you can wait and try to wait for a crash, but you might wait 10 years and then you're fucked. You're fucked. You lost all that time, right? It's called discipline. And so you can see in the best case scenario, again, by 36, right? And I keep bringing up 36 because that's my goal is to have 5,000 in passive income roughly by 36. In the best case scenario, there is a situation where I have $137,000 invested and I already have almost $1 million in portfolio value. This is a stretch. It is, but it is possible mathematically. $8,200 a month in dividends by age 40, 2.45 million, $23,600, right? This is assuming an 18% total return annually, which the last couple of years the market's done 20 plus percent, 22%, 24%, whatever. So it's not impossible. It does happen. But I am not expecting that this year, considering shit right now. What are we up for the year? Where'd the year start? January. January right here. All right, so here to here where we are today, we're up 12.19% year to date. So, looking at the fact that it's November and we're currently in a correction, probably not going to have a super spectacular year. Why is that? Well, because of this bullshit, right? This happened for the first 4 months of the year. Now, if you were to also look at this and say, I started investing here, look how well you did, 41%. See, that's why timing with growth is so important, but with dividends, it's not. And that's what I'm trying to teach you. So, if you're buying growth stocks like Robinhood, was up fucking 1,000% this year, and you're buying it when the stock market's up here, you're a psycho. You're a psycho. When it was down here in the dumps and all the speculative names were at their absolute bottoms, it's worth taking a stab at it, right? So I'm not saying Robinhood's not a good investment. I'm just saying there's a right and wrong time to buy individual stocks, especially growth stocks. But with this compounding portfolio, even if, right, we get the worst case scenario, a crash in 2030 to 2035 and then sideways forever, which is ridiculous, but it's possible, right? Even in that scenario, by the time I'm 40, I'm making $9,000 a month in passive income. That's 10 years from now. This is the absolute worst case scenario, right? So, interesting. Yeah, that's with 216. 940K. This has me 620K invested. I'm not sure where the difference is here, so 10% total return. Yeah, I just ran the numbers differently here, but so obviously it's going to depend how much you have in. But in either way, either bad case scenario. So in this 36-year-old example, worst case, have a portfolio value of 410. This same one, worst case, we have a port value of 270. Now why is that? I'm not sure. These are different scenarios, so. But either way, the point remains true. So here's what you have contributed. Here's what you actually have. You have way more money, right? Again, 20, 36. Here's what you have contributed. Here's what you actually have, right? Those are your worst cases. So in your worst case scenarios, you have between 200 to 400% more money than you do today. Okay? And these are like crazy unrealistic scenarios, by the way. Like 10% total return total. Right? 10% total return. By 2035, we have a market crash of 50% and the market's flat forever. Extremely unlikely. Okay? So market down by 50%, VIX 25 to 40, and then flat for 10 years. So this is saying like the market comes down 50% on high volatility, and then after that the volatility flattens for 10 years, and the market basically is just like dead. Okay? This is crazy, crazy unlikely. So here's the key takeaways, right? In this scenario, you still retire at 40 making 60K a year in passive from one account. I don't know if you can retire off 60K a year, but you get the point. Like 60K a year in passive income ain't bad. You know what I'm saying? Most people work for till they're 65 for that. In the average case, 115K a year in passive income by 40 years old. 727K a year by 50. Now look at the difference that 10 years makes. So 10 years, today zero, it's assuming zero. 10 years from now, I make 115K a year. Another 10 years compounded, you make that much more money. So we go from 0 to 115 and then 115 to 720 in passive income over the same period of time. That is the power of the snowball, okay? The best case scenario, you're a multimillionaire by 40, living better than 99% of people on Earth, right? I will admit that this is pretty this is pretty amazing scenario and very, very unlikely, but I just wanted to show you some different spectrums here. So let's see what it says over here. Reality check on the worst case. Even if the market loses 50% from the late 2025 levels and never recovers, worse than 1929, 1954, 2000, 2020. So this is Sezai's world right here. He thinks the end of times is coming. You still end age 50 with $3.2 million to $3.8 million and 26 to 36K in monthly passive income. So now that is at a 20-year point, right? So that's when I'm 50 years old. I'm shooting for better than that. But you got to look at the worst case, right? So at 40, in this scenario, it still has me 7.8 to 9K a month with almost $1 million in the bank. And in this scenario, $620,000 and $5,000 a month. Either one of these, I would still be fine with that. Would I be upset that it didn't perform like this or this? Sure. But would I still be a lot better off than I am today? 100%, right? So, what I'm trying to show you here is that this portfolio that I've put together for you guys, even if the world falls apart for a long period of time, this is going to take care of you. And if it doesn't, it's because the financial system itself or the country itself has imploded. And if that's the case, we're all fucked, right? So you can't plan for that other than buying guns and food, which I do as well. So yeah, I mean, hopefully this video kind of broke down some important insight for you guys. I also wanted to show just what you can do with AI. So as you can see, I've had a whole conversation with this thing. And it started with me simply saying, build me the perfect high income portfolio that is well diversified and uses drip to snowball. I want no NAV erosion. QQQI is a great example. So I gave it an example of something I wanted to build my base around, and it started giving me other things I could do that with. And then I kind of went back and forth with it. Okay, it seems pretty tech heavy, right? And I said, oh yeah, that's a good point. So I was pointing out that I was overexposed, and basically I had a conversation back and forth with this thing until I got to a point I was pretty happy with the allocations and the diversity and the strategy. And then I started to run numbers like, okay, give me an example if this happens. Give me an example if this happens. Here's my goal. Here's what I'm trying to achieve. Does it get me to this goal? How fast does it get me to this goal? Blah, 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 so on and so forth. Then I told it, you know, I have 60K cash right now. How should I get it into the market? And then it's like, you could just put the whole thing in tomorrow. I was like, fuck that, because the market's sitting at all-time highs, and it's like, you're right, valuations are crazy. Probably not a good idea. But you still want to get the snowball going. So then it helped me work out a plan to deploy the money, right? And I came up with a plan to do 10,000 up front. So that's like, I don't know, 15% of my capital, and then $2,000 a month or $500 a week until I get the $60,000 invested, expecting to buy the dip with $15,000 to $20,000 at some point in that 2-year window, right? I don't control if and when that happens, but if I see an opportunity where it makes sense, that's where I'm going to deploy it, right? And maybe I do another 10 instead, you know, like I can adjust this on the fly. Ultimately, it's not going to make that much of a difference over the long term, but in the shorter term, like the first couple years, it will, right? So I'm being strategic about it because I understand where we are in the market right now, but I could literally put the whole 60K in at the absolute peak. All right, let me show you what would happen even then. Assume I put the entire 63,500 in at the absolute peak of the market. I'm not doing this, but want to make a point to some friends. What would happen if I did that and then just did 1200 a month forever from there? Show me same thing, best, average, and worst cases. You know, if you really want to be thorough here, you should always check the numbers. You know, you're investing your money, you should probably check some of this with a calculator, but I have been, and it's been doing a pretty good job. Um, so here you go. By 37 in the absolute worst case scenario. So again, market takes a crap. If I just put the whole bag in today, and it was the top of the market, and the market's down 50% from here in 2035 and never recovers, I'm still by age 37 making $5,000 a month. All right, in the worst case. Average case, $5,300 a month. So you see, it didn't actually make that big of a difference. That's my point. And then 10K in the best case, right? And then here, this is showing you. It's hard to read. I put them in some tables real quick. There you go. Okay, so best case is left, average is middle, worst case right. Okay, so by 36 again, best case 475,000, worst case 325,000. I realize there's a big difference there. Again, looking at this, 36 years old, worst case 3,000 to $3,400 a month, best case $7,500 a month, average $3,800 a month, right? Now, that is if I was to put the entire wad in at the peak of the market. Okay? So let's see what it says. Worthy takeaway for your friends. Even if someone bought the exact top with every dollar of the $63,500, never got to average down once, then just set and forgot $1,200 a month, they would still hit 5K in passive monthly income by age 37 in literally every scenario. Wild. That's 7 years from now, right? This is why. This is why you should do this. So hopefully this breakdown, what I've been talking about here, makes sense to you. And if you don't understand how it works, there's a nice little breakdown on the math in the dollar cost averaging section on how compounding works. But it's amplified by this because you're getting income from covered call strategies on the high yield um, funds, and then also you're getting dividends from the growth and the um, like qualified dividend funds. I can't think of what they're called, but uh, so you know that all those dividends reinvested with the combination of you investing $1,200 a month, it really starts to add up. Okay, and another thing that people don't realize is like just because you're investing doesn't mean you can't get into it if you need to, right? Like this isn't a taxable account, which would be like a savings account. So at any point, if things get weird or I need money, like I can get in here and get it. Obviously, you don't want to do that because it slows your progress, but it's still there, okay? So anyways, I hope this was helpful and inspiring, and hopefully you can put together a similar plan. Don't be afraid to use AI to help you out. That's what it's there for. It's a tool, and yeah, I mean, it's technology like this that's changing the world. I mean, if you can't see how, like you used to need financial advisor to do all this, or somebody that really knew the world, right? And now you can just work your way through it with a normal conversation. It's pretty incredible. So, anyways, hopefully this helped. Catch you guys later. See ya.